let's talk a little bit about time frames. Each of you should have 3 different time frames that you use. The short term, the intermediate term, and the long term. And that's regardless of whether you're a short-term, intermediate, or long-term trader. Each type of trader will, in addition, have different time frames. The very short-term time frame for any trader is the time frame in which they execute. It's the time frame that you make your decision, you call your broker, you try to get the best fill, and you get the report back. That simple process is all that you do in the short-term time frame. The intermediate-term time frame is the time frame in which you do your primary analytical tasks. It's the time frame in which you look at your charts, deploy your systems, analyze your indicators, and come to your decisions. Once you've made a decision to buy or sell a security or to cover a position, to get out of a position, then you shift to the short-term time frame and you execute the trade in the short-term time frame. The long-term time frame provides your background analysis. That's, are we in a big bull market? Are we in a big bear market? What's the monetary environment like? What's the socio-political climate? Are the authorities likely to be accommodative to the securities that I like, or are they going to be hostile to them? Is the accounting world being turned upside down? It's the big macro factors that sit back there. The biggest mistake that is made in trading that I see is confusing time frames. And the best example of that is you get up and you look at your analysis, you find, for instance, a squeeze candidate. And we'll talk about the squeeze a little bit later. But you find a squeeze candidate, you review your indicators, you review the market conditions, and you say, okay, I want to buy this stock and I want to put a stop right here. So in order to do that, you fire up your level 2 quote screen and your tick chart, and you get your broker on the phone, and you execute the trade. And the broker calls back with a fill, and you don't shift back to your intermediate term tools. You stay stuck on that little tick chart and that level 2 display. And what happens? The security rattles around a little bit. You get nervous and you get shook out of the trade. That's a classic example of mismatching the task and the time frame. It's very important that you keep these things separate in your mind. To do so will allow you to organize your work in the most efficient and reasonable manner. I cannot stress this importantly enough. Your intermediate term time frame, for me that's daily charts primarily, is the time frame that you make your decisions in. Once you're in a position, you don't look at the short-term charts because that magnifies your emotions. It skews things in a way they shouldn't be making. So you're mismatching what's happening with the security with what was happening over here, which is an entirely different set of tools and time frames that you made the decision with. So it's like you're mixing apples and oranges. Try to avoid that at all possible costs. Time frames can be wildly variable. Long-term traders may, their long-term time frame may involve yearly trends. Intermediate-term time frame may be quarters, all the way down to, a very short-term trader who's their long-term time frame is an hourly bar chart, and they're real focused in their operations on 5 or 10-minute bar charts. And when they go to execute, it's the tick chart that they're looking at to pull off the best possible executions. Now, try not to confuse this categorization of the trading tasks, the trading environment, with the categorization of what your goals are. A short-term trader is still going to be somebody who's picking off just a few bars, 3, 4, 5 bars. An intermediate-term trader is going to be somebody who's looking for 20 or 30 or 40 bars. Long-term trader, 50 or 100 bars. This is a categorization of the trading tasks, and these two processes dovetail together, but they're separate processes. Now, once we've made a decision as to what our intermediate term time frame is, then we need to work on how to build our charts and how to select our indicators, how to pick the variables that we're going to use. Very important that you suit the variables to yourself, to your own process, and that you fit everything that we're going to give you here over the next couple of days to whom you are. And the first part of that is picking a moving average for the bands. Moving averages should be descriptive of the intermediate term trend. They do not provide buys and sells upon being crossed, right? We're not in the business of trading moving average crossovers here. We're in the business of selecting moving averages that often act as support and resistance, that define the intermediate term trend. The question we're asking here is the intermediate term trend up, flat, or down? So we're going to look at the angle of the moving average to determine the answer to that question. This moving average is, again, not going to be used as a crossover type system. It is going to be used to anchor the bands, which are going to provide us with our relative definition of whether prices are high or whether prices are low. So here's a couple of examples of moving averages. In this case, this moving average is too short for the task. It comes down here with the trend turns up, we get a cross here, and then we come back and we get this nasty whipsaw in here. Now, I've idealized this chart to illustrate this point. What this is this is a chart of a security that's declining a point every period, then rallies 20 periods, declines 10 periods, and then takes off again. So this chart has been, mechanically suited to illustrate the points. Obviously, what you're going to encounter in reality is going to be quite somewhat different. Here's a moving average that's too long. It misses the bottom completely. You get the first rally and the pullback, right? And then you get a signal after the bottom is completed and the new uptrend is already underway. So the first one was too short. You got a signal too early and it caused a whipsaw. The second one is too long. You get a signal way after the entire transition. This is the perfect one. You get a signal in the midst of the first leg up, then the moving average provides support to the first pullback. And that's really the key. This is the piece of information that will time and time again tell you that you have the right moving average. If you find that after a turn this moving average is being penetrated, right, then the moving average you're using is a bit too short for the securities you're trading. If you find that the moving average is coming in very late here, then the moving average is too long for the periods you're trading. That's what they look like when they're all combined. Too short, you get the whipsaw. Right. Just right, comes down, gets crossed on the first swing up, and then provides support to the pullback. And too long, you get this guy It's just too late in the process. You may say, well, that's not too late in the process to be buying this rally. Well, remember, we're also thinking about getting out of this trade. So we're trying to find something in mid-time here that tells us that we're transitioning from a bearish environment to a bullish environment. If we do this process properly, and we find several examples and you get a good fit, then it's going to work until some type of structural change enters that market. So the odds are that it's going to work going forward, but there can be no certainty because we don't know when structural change is going to occur. Sometimes structural change occurs because of news, sometimes structural change occurs because of regulation, sometimes structural change occurs because of the environment. The environment that we are in changes. And it's just something that you have to be sensitive to. And just so you don't get too confused here and too caught up in this, for equities, U.S. equities, in the markets that we trade in, 20 periods is a really good starting point, and you really shouldn't deviate from that unless you really have reason to. If you're trading a lot of very volatile high-tech stocks, you may want to adapt the parameters, but the base parameters that I'm going to end up giving you in the next few slides really will serve you very well unless you have real reason to deviate from them.
Do you stay with the simple moving average on that 20 periods, or do you go to exponential?
I stay with a simple moving average for most things, but I'll show you what happens when you shift averages in a couple of slides. The next key building block of Bollinger Bands after you've selected a moving average is volatility. Now, when I created them, I went through any number of versions of volatility because back in those days, standard deviation was very hard to calculate and it wasn't used much. Typically, they go back and they take the 6-month high and 6-month low, subtract the two, divide that by 2, and divide that by the average price of that 6-month period, and that would be the volatility estimate. I mean, that, in fact, was the way it was done. So I looked at a large number of different volatility estimates when I was building the bands. I looked at, simple mechanical ideas like that, ideas that were based on the range, the daily range of the bars. I looked on mean absolute deviation, which is another statistical measure. And I ended up testing 7 different methods. And standard deviation stood out time and time and time again as the method of choice. Bollinger Bands are created using that measure of volatility, standard deviation. It's just that simple. You don't really, I remember years ago, I was at a conference down in Dallas, I think it was, there was a famous statistician there, and he said, oh, no, you shouldn't use standard deviation, you should use mean absolute deviation, because standard deviation has this funky property. It magnifies the large deviations, and it's going to cause the resulting series to be too volatile for your uses. Well, that's exactly wrong, and I'll show you why in just a moment. It's a great question. The question is, Bollinger Bands are getting very widely deployed out there, and are they being affected by the fact that so many people are looking at them and they're so widely used? And the answer is undoubtedly yes, and that's a good thing. Technical analysis works because everybody sees it. It's about psychology. The market technician is really a psychologist. What he's doing is gauging the basic psychological mechanisms that are driving the market. So technical analysis, the more widespread that it is, the better, because more people will see it and the basic psychological mechanisms will be employed. Now, very few people are going to use these bands as I teach them to you. I'm going to try to teach you to identify the areas where I think they create opportunities. But those opportunities are undoubtedly being created because so many people are looking at them. In other words, secrets, you all know this thing. I mean, you must have met somebody in your lives that had some market secret, some method, some mechanism, some rule by which they conducted their operations, for which they would rather die than tell you what it is, right? It's like chili recipes, you know? I mean, you know, people guard their chili recipes. Well, gee, wouldn't you really feel better, you know, more generous and more wonderful of spirit if you passed that around? There are no secrets in our business, or at least none worth knowing. All the knowledge that we need is right out there, and everybody else has it too. When you see the bottom line of all of this that we're going to walk away from, is at heart of what I teach you is going to be some very simple ideas. But in that simplicity is contained a certain robustness, a certain view into the basic operating mechanism. And we talked about structural change before. That's what it will take to invalidate these types of approaches, not the fact that everybody knows. We trade volatility, not price. And nothing could be truer. You don't trade a $10 stock expecting it to stay at $10. You trade a $10 stock expecting it to go to $5 or to $20. So what you trade, what you want to buy or sell, is volatility and the expectation of volatility. You don't trade price itself. So by adopting volatility as one of your basic analytical tools, you are adopting the basic trading mechanism of the markets and deploying it as an analytical tool. If all stocks came out of their IPO at $12 and stayed at $12 forever, who would care, right? Even if they came out of their IPO at $12 and then went in a straight line over the next 2 years to $24, who would care? No one would invest because that knowledge would be immediately arbitraged out of the market, right? People would immediately take positions based on the certainty that the stock was going to go from 12 to 24 and arbitrage that value right back out of the marketplace. So, and how would that happen? The stock would go instantly from 12 to 22 3/4, and the difference between 22 3/4 and 22 and 24 would be the risk-free rate of return for the next 2 years. Right? So what we trade is volatility and the expectation of volatility, and it's very, very important to think about that and to understand that. And that's why it's so important to employ volatility as one of your basic tools. Volatility is highly variable. It changes dramatically over time. And that's why that old method of looking at volatility as a static feature, calculating the volatility of a stock for over a year and then using that number for the next year, doesn't work, because the volatility that you calculated is not the volatility that you're actually encountering in the market in a day-to-day manner. You know what the biggest villain of this? Betas. If a stock has a beta of 1 and the average rises by 10%, you expect the stock to rise by 10%. If there's a beta of 2, you expect the stock to rise by 20% based on a 10% rise in the underlying average. Well, betas are calculated statically. They calculate them on 5 years worth of data, and then they use that number for a long time going forward, maybe a year, until they recalculate them. You just don't bother to recalculate them very often because they don't believe that it's a dynamic number. It's commonly believed that betas are static, and in fact there's a very popular paper out there called On the Stationarity of Beta Coefficients, and it's an entirely paper that was written in the mid-70s that examined this issue of are betas static. So it's very important to understand that volatility is highly variable and volatility is cyclical. Now, because volatility is highly variable and cyclical, volatility is forecastable. It's not forecastable in the traditional sense that cycles are used. That is, you can't buy volatility every 22 days or every, it's not a regular cycle in the terms of time, and it's not a regular cycle in terms of amplitude. It's a cycle in the following sense, in that high volatility is a forecast for low volatility, and low volatility is a forecast for high volatility. That is the sense in which volatility is cyclical, and there's a great deal of academic work done on this. Garch and Arch are mathematical models of the volatility forecasting process. Garch means generalized, autoregressive, conditional heteroskedasticity. And in English, that means low volatility begets high volatility, and high volatility begets low volatility. And what the academics say is that while price is neither cyclical nor forecastable, volatility is both. And that'll be the basis of the squeeze, one of the trading systems that we're going to look at. So at the core of this process is this measure of volatility. Here's the standard deviation formula. Don't worry about the math. I just want you to look at one little piece of it. This part right here. This part says take the price of the stock and subtract the price of the average. So for each day going back, we take the price of the stock and we subtract the price of the average for that period. And then this part says sum all of those. Well, if you do just a little bit of thinking, you realize that if you take all the prices and subtract the average from all the prices and sum it, it's going to collapse to zero, right? Because the averages are, the prices are all right up below the average, and when you sum all those differences, you're going to get the average. So since you're subtracting the average from each of the points, you get zero. So mathematicians don't obviously want zero. What they do is they multiply those price changes by themselves, and that's what that is, squared. And that's what makes standard deviation perfect for our purposes. It takes the deviations from the average, the price of the stock, and subtracts the average and then squares the difference. Now, what happens when you square a small number? You get another small number. What happens when you square a large number? You get a really large number, right? So when prices deviate from the average, when we start to get rallies and we start to get declines, we start to get large deviations. And this squaring mechanism in here, which exists solely to cancel the negative signs so that we get a sum that's a sum other than zero, magnifies those deviations, and that makes the bands adaptive. So when you're trading near the average and you start to accelerate away from the average, the band accelerates with you. When you're trading near the average and you start to fall, the band decelerates with you. Keeping your definition of what's high and what's low nearby. So your definition is always relevant because of this wonderful squaring mechanism of the deviations from the average contained in the heart of the standard deviation calculation. You don't need to know the math, but the basic engine here is that, well, just think about it. If you multiply 1 times 1, you get 1. If you multiply 2 times 2, you get 4. If you multiply 10 times 10, you get 100. So the further you get away from the average, the bigger the inputs are into the standard deviation process, the faster the bands spread apart and the more adaptive they are. That's why that statistician was wrong, because mean absolute deviation removes the squaring process and just takes the absolute value of the differences. So you don't get that accentuation on the large differences. So bands constructed from mean absolute deviation don't work. But bands constructed using standard deviation work very well indeed.
John, do you get that different information?
That's a good question. The question is, do we get different information using closing prices versus typical prices? High-low close divided by 3, or open high-low close divided by 4. Yes, you do, and I highly recommend using the typical price. I think it gives you a better picture of what's going on. Especially if you think about it on a day where you get a large deviation, where you've made a new low, you go down, you open lower on the day, and you make a big excursion down to the low, and you come back and you close almost unchanged. If you're only using the closes, you've really lost a big piece of information. That's a big input into the process. If you're using the typical price, then you're using a price that's settled further deep into the range, further away from the range, I should say. So you get a better characterization and the bands will be more adaptive. So I highly recommend the typical price. I try to be as pragmatic a person as I possibly can. So when I did this, I looked around and I asked everybody I knew who was in the technical analysis business what average would be most descriptive of the intermediate term trend. And people came back with a lot of different ideas and they were scattered around, but 20, somewhere right in there, was the most common answer. So if people thought that 20 was descriptive of the intermediate term trend, that's kind of what I wanted to use. And I tested other values, but 20 worked real well, frankly, for listed stocks, which is primarily what I was trading in those days. And it turns out it works well for most things. Likewise, I found that 2 standard deviations gave me the containment I wanted. However, it is not the containment one would expect statistically, because there are 2 things going on. First, our sample size is too small. You need 30 samples in order to have a reasonable estimate of the population. And stock prices are not normally distributed. So the rules that one hears about standard deviations don't apply. I'm just using the calculation to determine my bandwidth, and practical eyeball type of exercise said that 2 was a perfect place to start. Here's a picture of what they look like. What I want to draw your attention to is just how adaptive they are. Here's our 20-day moving average right through the heart of the price structure. And here's our upper band spread 2 standard deviations above it. Our lower band spread 2 standard deviations beneath it. And note here, right about here, these bands are about 4 points wide. Right over here, they're about 12 points wide. Or, I'm sorry, about 8 points wide. Notice the dramatic difference. Here, they're 3 points wide. So we went from 4 to right here. It looks like about 8 points. And then over here, back down to about 2.5, 3 points. A little bit later, over here, we're back up to 7 points or so. Over here, this looks like about 11 points. So the volatility, our definition of high and low, is evolving with the price structure. When we're in a consolidation pattern, the bands tighten in. When we're in primary moves, the bands expand and the bandwidth widens dramatically to encompass the price structure. That's that little squaring of the deviations at work. That's what causes that. And it's the basis of their robustness. They will almost always offer you a good definition of whether prices are high or whether prices are low.
Now, what causes the squeeze? Is it caused by a transition or something?
The squeeze is caused by normally a period of consolidation in the price structure. And during that period, the deviations from the average are very small, because the average during a consolidation, the average comes in very tight to the prices. So there's very low deviation from the average. That causes the bands to squeeze together. So I heard a couple of questions about what average to use. Here's a chart using the simple moving average, and here's a chart using the exponential moving average. For years in Investors Business Daily, there was a father and son team that advertised better Bollinger Bands. I took it as a compliment. I guess that was right. But their better Bollinger Bands were simply Bollinger Bands using an exponential moving average rather than a simple moving average. Some people seem to prefer this approach. I don't. But it's really a matter of choice. When you calculate the standard deviation, inside that, the heart of the standard deviation calculation is a moving average. And that moving average for a 20-day calculation is a 20-day simple moving average. So it seems to me to make logical sense that we should then base the bands upon that same 20-day moving average. It's a consistent approach, and that's why I do it. Some people say that you get a little bit better adaptivity because of the exponential moving average. To them, I say, you need to shorten your moving average, because a 20-day exponential moving average front weights the data and is most closely approximated by a somewhat shorter simple moving average, maybe a 15 or 16 or 17 period moving average. So if you find yourself wanting to use exponential moving averages to get a little bit more responsiveness, I would suggest that you use shorter periods for your Bollinger Bands and stay logically consistent by using that simple moving average. Give it a try and see how you feel about it. It works pretty well for me. So we have 3 different averages here to give you a flavor of the different approaches. First, a simple moving average, then an exponential moving average, and then a front-weighted moving average. And you can see that they're all a little bit different in terms of the bandwidth they offer, but that there's very little change in terms of the key points that you want to look at. Keep your eye on these 2 points here, this high and this high. And I'm going to rock back and forth between the 3 averages. The bands are pretty well there. There's a little bit of difference. For the simple, the first high is a little bit outside the moving average, and the second high occurs right at the moving average. A little bit of a divergence. That feels right to me. The exponential takes a little bit of that away, and the front weighted takes even a little bit more of that away. That doesn't feel right to me. And I think you can go back and look through a number of charts and if you really feel that given the same time periods that the exponential moving average is doing a better job for you, try shortening the Bollinger Band calculation by a couple of periods and see if that doesn't do the same job for you. Why 2 periods? Why 2 standard deviations was a question I got before. Well, the way I determined them was by looking at charts more or less like this. This is the same chart we've been looking at with 1, 2, and 3 standard deviation Bollinger Bands. And I think you'll find that 2 standard deviation bands are just about the right ones. They provide a really useful definition of high and low. I think you'll find that the 3 standard deviation are just too wide. They're too far away from the price structure, and that the 1 standard deviation ones are just too narrow. You're getting outside of them far, far too often. But 2 standard deviations, when you get outside the bands, that's a very useful piece of information. At 1 standard deviation, you're outside the bands half the time. It's not such a useful piece of information anymore. I've taken 20-day Bollinger Bands and 50-day Bollinger Bands, and they're both on here. The slower moving average is the 51. The one that stays closer to the structure is the 20-day moving average. And look, during the advance, the upper band, they really fall together. And during the decline, you get very similar action. The upper and lower bands for both the 20 and the 50-day are very, very close together. So somehow this is an indication to me that we are looking at the basic price mechanism, because even if we've changed the parameters rather dramatically, you're getting very similar information here and here, which is where the information is useful. Of course, on the other side, there's a wild divergence, but then that's not the side that we're looking at. The side that we're looking at is the upside in an advance and the downside in a decline. And I find it really interesting that they fit together so well. Again, I think it's a basic proof of the viability of the approach. We're in contact with the basic price formation mechanism that's going on in the marketplace. Parameters. I've gotten a lot of questions about parameters. Always do. When I did this work originally, these were the parameters I came up with. 20 and 2 were the defaults. At 10 periods, I suggested you use 1.5 standard deviations. And at 50 periods, I suggested you use 2.5 standard deviations. Now, has the market evolved since then? Have we seen structural change to get back to an issue we talked about earlier? I think so. I think it really is kind of a different market than it was back in the very early 80s when I did this work. And when I did the work for the book, I went back and I examined all of the original work that I did. And what I found is that these are really the proper parameters. At 10 periods, you want to use about 1.9 standard deviations. And at 50 periods, you want to use about 2.1 standard deviations. The way I did this is I took 6 markets. I took the NASDAQ Composite, the Dow Jones Industrials, IBM, Cisco, the Deutschmark, and a commodity, I think copper. And I calculated Bollinger Bands for all of them, and I calculated the percent containment that I got using the default parameters of 2 and 20. And then I changed them to 15 days, and I changed them to 10 days, and I changed them to 25 days, and 30 days, and 40 days, and 50 days. And then I adjusted them so that I had the same containment that I had at 20 days. And it was remarkably consistent. If you want, at 20 periods, and you know, the tables are in the book, so I don't want to go through all the math here. But at 20 days, we had containment in the very, very high 80s, about 88% or so, if I remember correctly. At 10 days, in order to have the same containment using those 6 series, and I purposely picked them to be as diverse as possible, a currency, a commodity, you know, a NASDAQ stock, a listed stock, and two averages. And so in order to have the same containment, these were the new parameters. These were the old parameters based on the work that I did maybe in 1982, 1983, somewhere in there. And then when preparing for publishing the book last year, I went back through all of the material, redid all the calculations, and found that the change was much smaller than it had been when I first calculated. Now, I think that that's because the distribution of stock prices has changed. I think that in the past 10, 15 years, the tails of the distribution, that's where, for a statistician would say, we had the very large changes, the very big gains, and the very small changes. The tails have gotten fatter. What that means in English is that versus 20, 25 years ago, we're getting more big changes and more dramatic changes and less small days. And one way to prove that, and I show that in the book, is I look at where we close in the range. Back in the bad old days, in the 70s and 80s, we closed about 2/3 of the time in the mid portion of the range, the mid 50% of the range. These days we close about 2/3 of the time in the outer portion of the range, in the top 25% of the day and the bottom 25% of the day. So market conditions have changed, and we need less variation in the bands to accomplish the basic task of containment and the definition, to promulgate the definition of high and low.
You use the deviation to grasp the maximum coverage from your high and low.
I think that you want to start with the 20 periods and leave it alone unless it doesn't work. You know, it's one thing, you have to watch out here. There's a lot of variables. And if you start adjusting all the different variables, because they're going to be variables for the indicators too. If you start adjusting all the variables, all of a sudden you find yourself with 10 or 15 variable sets to adjust. And it's going to turn into a very, very large task very quickly. In my experience, 20 and 2 work in the vast majority of cases. And I do mean the vast majority of cases. So unless you have really firm evidence that you need to shift away from those periods, from those default parameters, I would stick with them. You know, but you can also become a variable juggler. You know, it just, well, a couple of indicators that we calculate from the Bollinger Bands. The first one is %B. %B tells us where we are in relation to the Bollinger Bands. %B at 1, we're at the upper band. %B of 0.5, we're at the middle band. %B of 0, we are at the lower band. %B is not contained between 0 and 1 like a stochastic. Right? It's free to range as we get prices above the upper band and below the lower band. So a %B value of greater than 1 means prices are above the upper band. A %B value of less than 0 means prices are below the lower band. And here is the formula for %B. It's the last minus the lower band divided by the upper band minus the lower band. So if we're at the upper band, then it's the upper band minus the lower band divided by the upper band minus the lower band, or 1. If we're at the lower band, the last is equal to the lower band, then it's the lower band minus the lower band, 0, divided by the upper band minus the lower band, so 0. So it's just a kind of shorthand notation to tell us where we are in the bands. Again, 1 at the upper band, 0.5 at the middle band, 0 at the lower band. And this is the tool that we're going to use to create our trading systems. %B tells us when we're in, where we are in the bands. A tag of the lower band is a %B value of 0 or less. A tag of the upper band is a %V value of 1 or more. And here's what the chart looks like. You can see there's quite a bit of variability here. This is 0. So on this occasion when we're outside of the lower band, %B is beneath 0. On this occasion where we're above the upper band, %B is above 1. Again, it just tracks out our path within the bands. Anytime we're at 0.5, prices are right at the average. Anytime we're above 1, prices are outside of the upper band. And what we're going to use this for is later on we're going to say if %B is greater than some value, so if we're near the upper band and an indicator is in a certain state, then buy or sell. So we're going to translate it into a rigorous system. Here's a look at %B, and in this case we've used an indicator called intraday intensity, which we'll go through in some depth, so no questions on it yet. The explanations are all coming, but we're just going to illustrate what's going on. Here we have a tag of the upper band and the indicator in negative territory. Here we had a tag of the upper band and the indicator neutral. Here we had a tag of the upper band and the indicator, well, you can't really tell because the price structure's off the edge there. But here's a tag of the upper band, neutral indicator. Next time we tag the upper band, the indicator's deep in negative territory. And that's going to be one of our basic mechanisms. Tag the upper band with a negative indicator, then sell the first down day. And so that would be this day right here. That is going to be a key part of our puzzle. We're going to get a signal, but we're going to wait for price confirmation of the signal. So we're not going to take the signal on the day that it comes. If we get a sell, we're going to sell the first down day. If we get a buy, we're going to buy the first up day. So we're going to, it's kind of like putting on suspenders. We're going to wait for our system to be actualized by market action, to be confirmed by market action. Then note here a walk down the lower band. This will be a topic that we'll address at length later. And all during that walk down the lower band, what do you get? An improving indicator. So %B running very low, tag here, very negative indicator here, way less negative indicator here, possible divergence going on, another tag of the band, not able to get to the lower band, neutral indicator here. This is a possible buy signal. We'll expand this one more. Buy the first up day. And there is a divergence in the %B. And that's what we'll talk about when we get to W bottoms. This is how we're going to diagnose W bottoms. This bottom is equal in price, but %B is higher on the second low than it was on the first low. So we have a divergence in %B, but no divergence in price. Price is outside of the lower band here, inside the lower band here. We've made a new relative low here, but we have not here. And we're going to talk about this at great length. So don't get lost here. Just here's the first introduction. It's kind of like this is the menu of what we're going to be talking about for the next day and a half. Again, here's that same idea. Come down, make a low, %B beneath 0, rally up, sell off, %B above 0. Note this, we've made a new price low here. Price has gone to a new low for the move, but percent B has not by the first up day. And that might be this day or this day. It depends on what your tolerance is. Some people might recognize this as an up day. Some people might wait to cross the moving average here. All right? Do we have a moving average that's nicely descriptive of the intermediate trend here? Yeah, it's doing a nice job. Make a low, cross it, come back, and then the pullback here occurs right at the average. It's not perfect, but that's the idea, right? Is that on this first pullback after the low is made, ought to stop somewhere near the average. And there you get it. And there you get a very nice rally out of that. So it's percent B and a W bottom. Bandwidth is our second indicator that we derive from the Bollinger Bands. Bandwidth tells us how wide the bands are. It is used, its primary use is to identify the squeeze. That's out in the world, but I'm going to teach you another use for it in terms of identifying turns at highs and lows. That's very, very important. So most people focus on the bandwidth purely to get a handle on the squeeze, but it's very good at diagnosing the end of trends, and it will be very useful for that. So bandwidth can be used to detect the termination of a strong trend. Bandwidth is expressed as a function of the average. Again, here's our relative framework. We're going to be able to compare bandwidth from security to securities to security. And that's key again. Everything we do will be in a relative framework, not an absolute framework. Here's the bandwidth formula. Bandwidth equals the upper Bollinger Band minus the lower Bollinger Band. Simply how wide are we? But then we divide by the middle band to relativize it, to normalize it, to make it comparable from not only security to security, but more importantly, from time to time for the same security. So you can go back and look and say, for this security, high bandwidth is 30% and low bandwidth is 5%. For another security, high bandwidth is going to be 40% and low 20%. It's going to be different for every security. So by normalizing it in this way, you can get a handle on how these things evolve over time. Remember we talked about the cyclicity of volatility? Well, here is the best example you're ever going to see. This is a plot of bandwidth down here, and this is a plot of the yield of a 30-year T-bond. And I've just drawn these arrows beneath every important low in this series. That's all I did. I mean, there's no mathematics here. I just went along and identified every low, and I put an arrow here. And if you count up the number of days on the chart and divide by the number of arrows on the chart, you'll find that the answer is 19. And for as long as I've been in this business, there has been a 19-day volatility cycle in the bond market. Occasionally it's broken, but more often than not, about every 4 weeks or so, 5 trading days in a week on average, a little bit less because of holidays. So about every 4 weeks, you're going to make a low in volatility in the bond market. And that'll be followed by a big increase in volatility. Now, it's not telling you anything about a low in price or a high in price. It's just talking about a low in volatility. And you'll find that over time, this is incredibly regular. It is the only such demonstration that I know of in the markets. No other security I've ever looked at has had a volatility cycle even remotely as regular as the bond market. Note the variability here. These lows are occurring near 2%, and these highs are occurring in the 8-9% area. So on average, volatility is changing by a multiplier of 4 on every swing. So volatility is 4 times as great every 10 days or so, or 1/4 as great every 10 days or so in the bond market. That's why it's so important to calculate these things in a moving manner, because these quantities are not static. They simply are not static. Here is the major use of the bandwidth calculation to identify the squeeze. Here we are at very, very low values, near 5%. You notice there's consolidation going on. The bands squeezed together dramatically. We went from 37% to 7% in a matter of 20 days. Pretty dramatic change in volatility conditions, about a factor of 5, huh? And then you get the squeeze. You buy the first day out, coming out of the squeeze, big move to the upside. So this doesn't forecast which way we're going to go. I have some systems that will give you for how to handle which way we're going to go. But it does tell you that volatility is very low. Expect very high volatility. And it tells you that volatility is very high. Expect very low volatility. It goes both ways. High volatility begets low. Low volatility begets high. Often, when a trend starts, you get a pulse in bandwidth. Right? Here's a very calm market. It's trading with an upside bias, not much, roughly 10 to 12 points over a couple of months. It's meaningful gain, but nothing really excited about. Here comes a giant pulse, and volatility soars, bandwidth soars to 50%, where it had been trading between 10 and 15% during this period. That's an impulse move. It's like a rocket engine going off. It's just like you were at Cape Canaveral. When they light that engine, it's an incredible amount of force that's being generated. And so think of this as a rocket motor for this stock. And it just keeps carrying higher. That, in essence, is part of my answer to your question before about how do we know not to buy them. You don't sell the end of a surge in volatility. It's just something you really shouldn't do. It often means there's more to come, especially when it's a giant surge like this. When volatility reverses to the downside, you get a warning that that leg is at an end. So big pulse in volatility, you turn down, end of that leg. 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 Turn down, end of that leg. You can see it. You don't have to have bandwidth to plot it. You can look at the lower band. After an up leg, when the lower band turns back up, that leg is over. It doesn't mean that the whole trend is over. It doesn't mean that the whole lift is over. But it means that the momentum of that leg is no longer expanding. Right? And you're most likely going to end a consolidation phase. So big pulse, turn down, trade sideways. Big pulse, turn down, a little sideways action in here. Big pulse, turn down, a little sideways action. And each time, the lower band turns back up. In each case, what's happened is the volatility expansion was so strong that it turned the lower band down. Even though prices were rising, the volatility is increasing so strongly that the lower band turned down. When that happens and the lower band turns up, it's often a signal to the end of that leg. Not necessarily the end of the trend, but the end of that leg. These are a couple of examples from a French book on Bollinger Bands by a fellow by the name of Philippe Kahn. Notice he picked up right away on all of his charts. Whenever that happens, he'll highlight it. You go up, the band turns down. As soon as it turns back up, the move's over. And notice also, He likes these parabolics. This is an example of Wells-Wilder's parabolic in there. We're going to give you an example of how to use it, but we're going to modify the parabolic to suit the band structure. Here's another example from his book. Same idea. Here's your impulse. You're outside of the bands. Look at bandwidth soar. Here's your turn up. There's the end of your trend. What we're going to do is take a look at the formulas and how they work, and try to give you some idea about how to translate these ideas into the kinds of tools, technical analysis tools, that you're likely to meet. I'm going to use two different examples here. One Metastock, the other TradeStation. I think they're, between them, the two most popular platforms. In order to do this, the first example we'll look at is how to construct Bollinger Bands. Now, both of these programs already have Bollinger Bands built into them. But if they didn't, this is a kind of a good example because it shows you the process of how to get something done in these. The first thing we're going to need is we're going to need to ask the investor some questions. What do they want to do? Do they want 20-day bands? Do they want 50-day bands? How wide should they be? So that's what we use this input statement for. And we're going to take the input, we're going to call it periods. So when the indicator is run, it's going to prompt the user for the number of periods. And we're going to say, suggest a range from 5 to 100 with a default of 20. And then take whatever that user says and stick it in a variable called BB periods. And then we're going to do the same thing for width. We're going to prompt the user, say, what bandwidth do you want to use? We're going to suggest a range of 1 to 5 with a default of 2. And we're going to plug that into a variable called BB width. Then we're going to use BB data as the variable to calculate the bands on. It could either be the close, the typical price, or Metastock has an interesting choice. You could use P, which simply means to calculate it on whatever is in the window that you drop it on. In other words, the way an indicator works in Metastock is you have a little window up top. You grab the indicator with your mouse and drag it down and drop it in one of the chart windows. So if you use P, the indicator will calculate on whatever's in that window. If you use C, then it would calculate on the close. If you used typical, then it would calculate on the typical price. And so here we define the upper Bollinger Band as a moving average, MOV, of BB data. In this case, it's on whatever we drop it on for 20 periods. And the S means use a simple moving average. And we're going to add to that the width of the bands times the standard deviation of the data for the number of periods. For the middle band, all we need is the moving average. We don't have a standard deviation function, so the middle band equals simply the moving average of whatever data we're using, the close or typical price, for whatever number of periods we specified. And again, it's a simple moving average. Lower band is a similar process, moving average, but this time minus instead of plus the bandwidth. That was this variable here that we asked the user to supply. 2.0 was the default times the standard deviation. So all we've done is take some fairly simple building blocks, the number of periods, the width of the bands, and what to calculate it on, and then calculated them using this kind of arcane English-like language. The curly brackets are comments. They just give a little descriptive comment to tell you what's going on there. And the semicolons mean that it's the end of that line. You can write a very, 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 very long line, and you have to tell Metastock where that line ends. So you put a semicolon at the end of every line that you write. And that way, Metastock knows that that's the end of a line, process that line, and then go on to the next one. Now we're going to calculate %B, and notice what we're going to do. Look at the top piece here. It's not going to change at all, but we're going to add a new piece down here. Here's our calculation for %B. The last, which is BB data, minus the lower band, divided by the upper band, minus the lower band. And then here's a little trick to draw some lines on the chart so you have some reference. The number 1 and a semicolon, and the number 0 and a semicolon. So that will draw a 0 and a 1 right across the chart. So you have an upper bound and a lower bound. So it's exactly the first formula. Nothing changed there. We just added the calculation of %B using the same code that we had developed for the first example. Now, this code was written in Metastock and tested in Metastock, so you can just copy this in and go. Right? So that you don't have to worry about being able to write this. And then here's the same drill again. Notice, again, nothing on the top changes, but we just changed the bottom line here, and we're calculating bandwidth. Upper band minus the lower band divided by the middle band times 100. And if you forget these little semicolons, it's going to get really mad at you. So put a semicolon at the end of every line, and this way you can go in and you can change this to be anything you want. Want exponential averages? Change the 3 S's to E's. That's it. And then you have Bollinger Bands with exponential moving averages. Want to change the default periods to 10? Just change that 20 to a 10. Want to change the default bandwidth to 1.5? Just change this 2.0 here to read 1.5. Want to use the typical price? Just get rid of this P and replace it with the word typical with those closed brackets. Want to use the close? Just get rid of the P, put the C in there. So it's just that straightforward. So you ought to be able to just copy this code into, you go indicator, create a new indicator, give it a name, and then just copy this code right in there, and it'll work for you. Now, for TradeStation users, it's a little bit different world, but it's the same drill. We're going to input. TradeStation doesn't allow you to specify a range. It just allows you to specify a default. So we're going to use BB data and with the default of a close, BB periods with the default of 20, and BB width with the default of 2. TradeStation makes you define your variables before you use them. Metastock creates them on the fly. So TradeStation, you have to tell it that you're going to use variables. So you use this variable statement, and you say, I'm going to create a variable called the middle Bollinger Band, one called upper, one called lower. And then it's the same drill, but I did a little bit of a different twist this time to give you an idea how you can make your process a little bit easier. First time I'm calculating the middle band. It's just simply the average of BB data for BB periods. So the average of the close for 20 periods. In TradeStation, there's a separate function for exponential moving averages and for front-weighted moving averages. Rather than changing the argument here, you'd actually have to change this to say exponential. And then I take, to calculate the upper band, I take the middle band, which I calculated here, and add the width times the standard deviation. Same thing for the lower band, except I subtract the width times the standard deviation. Now, TradeStation, you also have to tell it what to plot. So in this case, I'm going to plot 1 is going to be the upper band, and this is the label that it's going to use on the screen. Plot 2 is the middle band, and plot lower, and then call it BB-lower. So when you plot these on the screen, on the top clip of the screen, it's going to say the 3 names with the values right next to them. I put the changes in blue. So to calculate %B, we need to add a new variable for %B. And then using the same calculation from before, %B equals the data minus the lower band divided by the upper band minus the lower band. And there's that semicolon again to terminate the statement. And then plot %B and plot a reference line at 1 and call it 1. Plot a reference line at 0 and call it 0. Same for bandwidth. I've just replaced the %B variable with a bandwidth variable and then put a calculation in here. Bandwidth equals the upper band minus the lower band divided by the middle band times 100. And then plot the variable called bandwidth, label it bandwidth, and plot a reference line at 0. And the reason for that is often bandwidth will end, the lowest piece on the chart will be at 2 or 4 or 7. And for my eye, it's better to force the chart to start at 0 so that you can see how low bandwidth really is. Otherwise, it gives me a kind of awkward illusion on the chart. So that the way you get the chart to force the chart to start plotting at 0 instead of starting plotting at the lowest value of bandwidth is to tell it to plot 0. People always ask, by the way, how to prepare best for the markets, and I do have an answer for that. I think that you ought to go down to your local community college and take a few courses. Not many, just 3. I think you ought to check into the psychology department. I think you ought to take Intro to Psychology, just the basic survey course that they give in any community college. And I think you ought to take Mass Psychology, which you're going to find it a little bit harder to find, but it's still, you still can still be able to find it. And I think you ought to take a statistics course, not the one in the math department, the one they give right there in the psychology department. And the reason is they'll teach you how to use the statistics, not necessarily how to calculate them. And that's really the important part, is to understand how to use the numbers and what the numbers mean, not so much to be able to do the math and do all the such behind them. So I think those 3 courses, Intro to Psychology, Math Psychology, and Statistics as offered in the Psych department, will stand you in very good stead for a successful experience in the market.